Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment for Thursday, June 16th. Well, two central bank meetings overnight that, as expected, resulted in no change in policy. But the Fed meeting in particular was interesting in that once again, the committee scaled back its expectations for rate hikes. They still see 2 more hikes this year, but now see only 4 hikes next year instead of 5, and are leaning towards 4 in 2018 instead of towards 5. Meanwhile, however, they left their forecast for inflation largely unchanged, meaning that they see real interest rates remaining much lower than before. As a result, the dollar weakened across the board. Note that even as the committee lowered its forecast for interest rates, the market's forecast also fell. This is what happened at the March meeting as well. The result is that the official forecasts still remain well above the market's forecasts. Someone is going to be proved wrong yet again. The Bank of Japan also held its fire, even though it predicted that inflation would be slightly negative or about 0% for the time being. Now that's slightly worse than in April when it just said inflation was likely to be about 0%. It looks like the Bank of Japan is admitting defeat on deflation. Either that or it's just waiting for next week's Brexit vote. If the UK votes to leave the EU, there's likely to be a big inflow into the yen, which is perceived as a safe haven currency in times of trouble. It'd be foolish for them to ease now, only to see the effect wiped out next week by events outside their control. Continuing on with the string of central bank meetings, the European day starts with the Swiss National Bank meeting. Analysts unanimously expect no change in rates. The recent data for Switzerland has been encouraging, with the rate of deflation gradually diminishing and the manufacturing PMI rising for 4 consecutive months. Most importantly, the euro-Swiss franc rate seems to have stabilized. Accordingly, there's little reason for the SNB to increase the level of monetary stimulus. On the other hand, it's also too early to start talking about normalizing rates there either. The meeting could prove to be a non-event for the markets. Last time around, the euro-Swiss tried to rally but wound up falling around 20 pips. Now, the Bank of England has a difficult job a week before Brexit, before the Brexit vote, pardon me. Most of the data since their last meeting has been weak, such as the retail sales figures that will be announced in a few hours before the results of the Monetary Policy Committee meeting are revealed. That suggests the MPC is likely to sound more concerned about the economy and less in a rush to raise rates after the Brexit vote, assuming that it's Remain, than they were before. If so, sterling could weaken on the news. It's also possible that Governor Carney could use this last opportunity to make his voice heard on the Remain side, which might also cause a weaker pound by highlighting the risks to leave. For an update on the U.S. indicators coming out today, please watch my North American opening market comment later today. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.